if I just tell you,
Sir, I think you are not audible.
now I am audible.
Yes,
I'm
sir.
audible. Huh?
Yes, sir, you're audible.
So this part I have done, I believe. So this is finished. Different exchange rate mechanism. Then impossible trinity. Along with that, I have done central bank intervention. And we have also done sterilized intervention, unsterilized intervention. We have done use of gold standard. This we have done, I believe, now. Yes or no?
Yes, sir.
So this finished, and we also discussed that you can go through this. These are all different crises which happened during, all over the world during different times, which basically affected the foreign exchange market or the international trade also. So now why US dollar is so important? So you have seen in our last class, we discussed that slowly, initially it was gold standard. So gold standard, it was only gold, then it became gold exchange standard. It was gold, US dollar and UK pound. And then we have a Bretton Woods system where US dollar became the key currency. Okay, so US dollar became the key currency because by that time, Second World War was over, and though UK was the largest economy that time also, but slowly US was becoming very important US economy, and that time US had maximum trade with rest of the world slowly. So US and of course US has a lot of natural resources that I have discussed earlier. Now consider the cases. So initially, how US over a period of time, how US became important, that you have seen, and why it became important. One major reason is trade. During that time, US had maximum trade with rest of the world. So when you have maximum trade with rest of the world, naturally your currency becomes popular because everybody is trading with US in US dollar. So now when you are trading in US dollar, it is not that everybody is. I said US had maximum trade with rest of the world. That does not mean that US is only exporting to the rest of the world. So there are US was also importing from other countries. So some countries were selling to US, some countries were buying from US. So in the process, some countries, they developed some surpluses. Surpluses in the sense, surpluses of foreign currency in the form of US dollar. So what do you do with this? So when you have surplus US dollar, what do you do with that? Keep it in the cash box? No.
So lend others, invest in other markets.
So invest in other markets, lend others. Now, first of all, say for example, India has a foreign exchange reserves of some 626 or $36 billion. How India invest? Mostly in, you don't keep them in the cash box. So some in gold. Why gold? Because gold has value everywhere. Some in gold, some in assets denominated in other currencies, some in SDR. So let me first tell you what is SDR. SDR is a full form is statutory drawing right. It is a virtual currency of World Bank. So it is the value of SDR is determined on the basis of weighted average. Earlier it was 4 major currencies, that is US dollar, Euro, Japanese yen and UK pound. Now from 2016, Chinese yuan is also included. So now it is a weighted average of 5 major currencies in the world. Okay. Now, you invest in gold. That is fine. You can buy gold. I think India is now the largest India has the largest reserves of gold. And you also invest in assets denominated in other currencies. So what do you mean by assets denominated in other currencies? Basically, you buy the bonds issued by other countries. What do you mean by buy? In other words, Ankit has already pointed out that you can lend to others who need it. Whom do you lend? Because you know that there are countries at this moment, Sri Lanka needs money. Recently, in fact, India has given a loan to Sri Lanka. But point is, during the Asian financial crisis, you must have seen that is there a lot of investment in these countries. But when there is a trouble, everybody sold their assets and they parked the fund in safe haven, which is US Treasury bill. So US Treasury bill is considered to be the safest place, in the safest instrument in the world. So our discussion is why it is considered as the safest instrument in the world. So if that answer, and that will give the answer of why US dollar is so popular. Okay. So first thing is, we have already discussed US has a lot of natural resources, so currency value also depends upon that. But what are the other things which determines the safest thing? So if you buy US Treasury bill, like right now, Sri Lanka is in trouble. Why Sri Lanka is in trouble? Because it has huge amount of debt. Why it cannot repay the debt? The most of the debt it has taken in from China. So China has given the debt either in Chinese yuan or in US dollar. Now Sri Lanka cannot repay the debt. Why? Sri Lanka cannot print dollar. Neither it can print Chinese yuan. What is the advantage of US? So if US falls into the similar position, that is, suppose US has taken a huge amount of debt which it cannot repay. So it can print dollar and repay. So that first is US has an advantage. It can print dollar and repay the loan. So that is why we invest our money in US dollar denominated asset issued by United States. Sri Lanka can also issue bond denominated in US dollar. India can also issue bond denominated in US dollar. Germany, which is doing better than US, can also issue bond denominated in US dollar. But all these countries have the same problem. That is, in case if necessary, they cannot print dollar. So if they are in trouble, they cannot print dollar and repay their loan. Got it? So one major reason why US dollar is so safe. This is not the only reason. There are others. One major reason why US dollar is safe. That is, if necessary, US can print dollar and repay the loan, which other countries cannot do. Question is, why invest in dollar? Why not invest in yuan? Or why not invest in euro? Suppose Germany issues euro, which is another very strong currency after US dollar. Germany cannot print euro because in Eurozone, there is a common central bank, European Central Bank, which can print money. Money is printed by the central banks. So Eurozone members, they cannot print euro. They have a common central bank which can print euro. So Germany cannot print euro. Neither it can print dollar, though Germany's condition is better than that of US. So what about China? Or what about any other currency? See, for example, we have generated surpluses in US dollar. Now, suppose I want to invest in asset denominated in euro or denominated in yuan. So what I'll have to do? I'll have to convert my dollar into euro. So suppose I decide to invest. Of course, India invests some in euro denominated assets. But suppose I decide to invest my money in euro denominated assets. So what I'll have to do? First, I'll have to convert my dollar into euro. So when I convert my dollar into euro, there is a transaction cost. So I invest in euro. On the assumption that Germany is safe, nothing will happen to Germany. At the time of repayment, Germany will again repay me in euro. Again, at that time, I'll convert my euro to dollar. Why? Because dollar has maximum demand. Okay. So naturally, both the times I'll be paying transaction cost. So I prefer to, instead of that, I prefer to invest in dollar. This is one. Next question is, I can buy bond issued by a country if the country needs money. So for example, China. I can invest in bond issued by China only when China will issue bond. But China has a current account surplus. China does not need money. Rather, China is now giving loan to others. So first, another condition is but why US is issuing bond, or why US is issuing treasury bill? Because US runs a current account deficit and US needs money. Since US needs money, why it needs money? Because it runs a current account deficit. So another condition is the country must run a current account deficit in which it needs money and it can issue bond. So what are the conditions, different conditions? One is, first, of course, the first condition is you must have natural resources. Then you must run a current account deficit. Of course, over a long period of time, US dollar has become important. You must run a current account deficit, number one. Number two, of course, you have the ability to print money, which US has. China can also print one, but the point is China doesn't have a current account deficit. Germany also does not have a current account deficit, of course, but Germany cannot print euro. But there are many other, say Canada can print Canadian dollar, but condition is, you also have to have linkage with rest of the world. Our linkage with US is more than our linkage with Canada. So that is also you need to keep in mind. And there's another thing which I normally is not written in the book is basically, so up to this, any question?
Sir, I had a question.
Sure.
So, like you said that the US can print money when it wants, but
so
like
printing money does not solve all the problem. That is one condition.
Yes, sir.
So lot of people think that one day US will become bankrupt.
Yes, sir.
Yeah. So next,
Sir, the question was like, but I had heard somewhere that like it's also tied to the gold reserves of the country, like US. So they have to.
Last class we had done gold standard, gold exchange standard. Remember?
Yes, sir. Yes, sir.
So that time everybody used to print money by keeping gold reserves. Is that fine?
Yes, sir. Yes, sir.
So now it is fiat money. There is no question reserves. So anybody can print money.
Okay, sir.
Sir, I have one doubt.
Sure.
Sir, you told that when Germany issues a bond, it pays in dollar, then I have to convert it in my rupees or any other.
Germany any country can issue bond denominated in US dollar. India can issue bond denominated in US dollar. But will that be as safe as the bond which is issued by US? No. Why? Because India cannot print dollar. Similarly, Germany also cannot print dollar. It is US which can print dollar. So bond issued by, though the condition of Germany is better than that of US, but since US can print dollar, Germany cannot. So even if Germany issues bond denominated in dollar, that will not be as safe as the bond, dollar denominated bond issued by US. Just hold on for a second. Just hold on for a second. Yeah, sorry. Yeah, carry on, please. Yeah, somebody was asking a question, please. Ankit.
Yes, sir. Yes, sir. You have just told. Sir, I have another question. We can see in the news that the two countries are going for a currency exchange. Like India has and Japan has got into a currency exchange. So what is the correlation of that in terms of dollar? Like why they are not going for dollar and exchanging their currency among themselves? So is there any kind of correlation with that, or it is a complete?
Yeah, so normally when do you need Japanese yen? So it's not a currency exchange, it's called a foreign exchange swap. So that I'll be doing slightly later today only when we'll do foreign exchange market. When you need Japanese yen, then only you do currency exchange. So see, for example, what do you mean by Japanese yen? So suppose you take a loan from Japan. Japan gives a lot of loan to India for development of construction of flyover, etc., etc. So one thing is if it comes in the form of yen, then what you do? You buy the product, buy different items from Japan and pay in yen. Solves your problem. Otherwise, you have to convert that. Suppose you are, what do you call? You are buying it from US, so you have to convert yen into US dollar and then buy it from US. It's like that. Okay. So when you need Japanese yen, at that time you convert it in Japanese yen, and later on you exchange it on a later date. Got it? So that is possible. It's a common thing.
Okay, sir. Thank you.
So there is another point which I forgot, but anyway, another very important, apart from this economic factor, there is another factor which also comes into the picture. That is basically, popularly known as, but not popularly, whether it is not written in the book, but you can definitely, it has a role. That is your muscle power. What do you mean by muscle power? Basically, if you see Second World War, US played a dominant role. US played a dominant role means US was the most important power. Now, if you see 1990, there was first Gulf War. US attacked Iraq. So after that, there was some, basically Iraq captured some oil field in Kuwait, and for that US attacked Iraq. And after that, what happened? Later on, again US attacked Iraq, and why for the second time? Because US claimed that Iraq is manufacturing chemical weapons for mass destruction. Okay, so once America captured Iraq, they did not find a single chemical weapon for mass destruction. Okay, I refuse to believe that US intelligence failed to give this information to George Bush. That there is no weapon. Recently, there is a movie which I have seen. It is on YouTube. It is on Netflix. You can see Green Zone. I think Matt Damon is one of the hero. So you can see this movie. So it's on this. So failed intelligence report. So basically, and then after that, Saddam Hussein was killed. So one major reason was Saddam Hussein was the first person in the world who wanted to trade oil in a currency other than US dollar. Got it? That is the reason probably he was brutally killed. Now, what is the advantage if your currency is the reserve currency? Dollar is called the reserve currency where maximum trading takes place. What is the advantage? The biggest advantage is there is no currency exchange rate risk. See, for example, when India is trading with US, it's trading in US dollar. So whether you are importing from US or exporting to US, both the cases it is US dollar. Suppose you are importing from US, so you have to pay in US dollar. So there is an exchange rate risk. So when you are exporting from US, you are receiving US dollar. Again, there is an exchange rate risk. So, but what about the US customers? So they are buying in their own currency, they are selling in their own currency, so they don't have any exchange rate risk. So when your currency is the reserve currency, you have this problem. And similarly, countries like India, when we are trading in any foreign currency, another problem which we have, like we always have to maintain some amount of foreign exchange reserve, which is not the case for US, because since all the trades are in US dollar, if necessary, they can print dollar. We cannot print dollar. Anyway, again and again, I'm telling you, printing dollar does not solve all the problem. But they can print dollar if necessary. We cannot, because our currency does not have so much of acceptability in the to the rest of the world, which dollar has. And in one day it has not become. And muscle power, as I have told you, that is one major reason why Saddam Hussein was killed was he was the first person who wanted to trade, because oil is the commodity which is traded most in the world. Saddam Hussein wanted to trade oil in a currency other than US dollar. That does not mean all the oil in the world is traded in US dollar. Russia trades oil in euro, not in US dollar. See, one major reason is Russia sells most of its oil and gas to Europe, and that is why it is in euro. But Russia believes that one day US will become bankrupt. Anyway, forget about that. Iran also trades in euro because US and Iran, they have a problem. Now, let me also tell you, so there are a difference between what do you call Iran and Iraq. Iran is strategically located at a place, the state of Hormuz, 25% of world's oil, goes through that area, passes through that particular place. So Iran can create disturbance at any point of time. So this is one case study for political risk. But anyway, let me explain in one point, in brief. So Iraq and Iran, there is a difference, and Iran is a bigger power than Iraq, definitely, but not as big as Russia. So I'm sure you have seen that for the last 1 week, there are a lot of tension between Russia. They can attack, Ukraine, they can capture Ukraine and so on. Now, again, there is a difference between Russia. China is also trying to capture Taiwan. So, in fact, Sunday, the maximum number of flights cover, had gone into Taiwanese sky. So basically, it is two major power. Now, Russia and China, they also have a lot of arms and weapons, so they are also very big power. So that is why US, if it wants, it cannot do. See, US is also threatening that it will impose, if Russia does anything to Ukraine, there will be sanctions on Russia. China is also in the process of, because Xi Jinping said that he believes that once Taiwan was under China, so he wants to capture Taiwan. Now, if that happens, can US impose similar kind of sanctions on China? Now, thing is very simple. China is now a bigger power than Russia. So this muscle power also plays an important role for becoming your currency, for making your currency popular. So the point is, one is definitely trade, and the other is these things. So who is more powerful? That is also very important. And another very important thing also you need to keep in mind, one major event which basically helped, Second World War, which was popularly known as Manhattan Project, where this atom bomb was discovered. The project was of course, in US. Now, you must be aware that when once Hitler thrown out all these, scientists out of Europe, they all had gone to US, including Einstein. Okay. Now they discovered this atom bomb, and after Hiroshima and Nagasaki, people realized that what is the power of the bomb. And of course, this formula of that bomb was transferred from US to USSR, the then USSR. I don't know how many of you can read Bengali. There is a very famous book in Bengali called Bishwash Ghatak, means traitor, by Narayan Sannal. If you read the book, it talks about how the bomb was discovered and how it was transferred. So one major thing happened during that period of time. So scientist who transferred that, he is also a Nobel laureate called Dr. Klaus Fuchs. So he was offered $1 billion in those days, but he did not take a single rupee, single penny, for the reason he said that scientists do not work for money. So basically by transferring that formula to Russia, so he balanced the world economy. Otherwise, US would have been, during that period of time, US would have been far, far more powerful than USSR. So which actually did not happen ultimately. So this muscle power also plays a very, very important role in determining the reserve currency. But you cannot write that in the book, so this you will not get, but that is what also plays an important role. This is not an economic event, of course. Any question? Confusion? Anybody? Yeah.
No, sir.
Can you start the next chapter?
Yes, sir.
So foreign exchange market is by far the biggest market in the world. Biggest market in the world means if you compare with the stock market or any other market, so it is the largest market in the world. Okay. So what is the foreign exchange market? The foreign currencies are traded. So in India, apart from Indian rupee, all currencies are foreign currency. I repeat, in India, apart from Indian rupee, all currencies are foreign currency. Okay. So the foreign exchange market is the market in which currencies are bought and sold against each other. Okay. So in India, though there are cross-currency trade, when you can buy dollar by paying pound, that is also possible. But normally, most of the transactions where there is a deal in the foreign exchange market, it is again against Indian rupee. So the interbank foreign exchange market is an over-the-counter market. We call it OTC market. What is an OTC market or over-the-counter market? It is between two parties, buyer and seller. Against that, we have something called stock exchange. Three parties, buyer, seller, and exchange. So what is the difference between an OTC market and a stock exchange? You will again do later. But for the time being, OTC market, since it's a two-party buyer and seller, so there is a counterparty risk. That is, anybody can run away. The buyer or either the buyer or the seller, anybody can run away. But if it is a stock exchange, buyer, seller, and the exchange, so the counterparty risk is assumed by the stock exchange. So there is no risk in a stock exchange. Okay. So when you are buying in a stock exchange, you are buying from the exchange. When you are selling in the stock exchange, you are selling to the exchange. Okay. So basic idea is in a OTC market, it's simply between two parties, buyer and seller, and many cases it is over the phone also. So we'll see. The participant here will be talking about wholesale market. I repeat, here we'll be talking about wholesale market. What do you mean by we will be talking about wholesale market? So there is a retail market, like you go to a bank and you see the rate and you can trade. That is a retail market. wholesale market is a very big. So here mostly we'll be talking about wholesale market. So the participants in the wholesale market are commercial banks, investment institutions, corporations, and central banks. Okay. Currency broker act as middlemen between dealers. Okay. So mainly it is the banks and investment institutions which and corporations, of course. Central banks, they intervene when it is necessary. So major currencies now, of course, is the US dollar is the #1 currency, followed by euro, then Japanese yen, then GBP, then Swiss franc. CHF stands for Swiss franc, Australian dollar, Canadian dollar, etc., etc. So if you see, this is the, I don't know whether you can see fully or not. So #1 is the United States dollar, which accounts for 88.3%. Total is 200%. Why total is 200%? In a transaction, in a foreign exchange transaction, when there are two currencies are traded. So suppose you are buying US dollar by paying Indian rupee. Okay, so naturally, one currency is US dollar, another currency is Indian rupee. So both are transacted. So transaction wise, for each transaction, there are two currencies. So that is why total is 200%. So #1 is US dollar, you can see 88.3%. #2 is euro, 32.3. Japanese yen 16.8, pound sterling is 12.8. So these are the four major currencies. India is number 16th, Indian rupee, you can see 1.7%. Okay. Chinese yuan, which is slowly becoming popular, 2013, it came first top 10, then 2016 it was 9th position, and 2019 it is 8th position. So what we are doing is basically it is result is April 2019. It's a triannual report of Bank for International Settlements. So next report will be April 2022. So daily turnover is around 6.6 trillion US dollar. So this is the size of the market now. So this is the thing. Sum total will be 200%. I have already uploaded the slide. You can see because the figures are very small naturally. So according to the Bank for International Settlements, the preliminary global results from the 2019 triennial central bank survey of foreign exchange and OTC derivatives market, total is average $6.6 trillion per day in April 2019, which is up from $5.1 trillion in April 2016. So measured by value, foreign exchange swaps are traded more. What is foreign exchange swap? We'll discuss. We have foreign exchange swap is $3.2 trillion per day, followed by spot trading at $2 trillion per day. Okay. So let me tell you what is spot transaction, what is forward transaction, what is foreign exchange swap. So suppose you go to the market, take the rate, pay for it, spot transaction. Any question? What is a spot transaction? Go to the market, take the rate, pay for it, spot transaction. Any question?
No, sir.
So, yeah.
Like, can you repeat why there is 200% in that whole list?
Wall?
Why 200%, sir? Like, US dollar contribute.
So total, when you are trading, suppose you are buying UK pound. Okay. So when you are buying UK pound, so there are two currencies which are involved. One is Indian rupee, one is UK pound. Similarly, suppose one UK citizen, he is buying Swiss franc. So two currencies are involved. One is UK pound, one is Swiss franc. Suppose he is selling Swiss franc, still two currencies are involved. Okay?
Yes, sir. Yes, sir.
So that is a total is 200%. So spot transaction, again, you go to a bank, see the rate. So these are all retail market. You can go to a bank, see the rate, make the transaction on the same day. Suppose see the rate, you agree, pay the money, buy the dollar, or see the rate, sell the dollar, get the money and come back. So these are all retail market. We are not talking about retail market. Wholesale market, the transaction, it is T+2. So it is basically, throughout the day transaction takes place. Then at the end of the day, the banks send confirmatory notes to each other and it is settled, after 2 days. So how the transaction takes place, that I'll show you later. So naturally, this is what is called wholesale market. We are talking about wholesale market. So this is what is called spot transaction. Today you make the transaction, delivery will take place after 2 days. Okay. Any question? So today 25th. Yeah.
In the normal stock market, the day is T+1, right?
Till now T+2. SEBI is making it T+1. Will be. Normal stock market T+2.
So that is applicable even for foreign market, foreign exchange market, T+1, if at all it makes.
Let me once again clarify. Stock market, we are all trading, okay?
Yes, sir.
In the stock market, currencies are also traded, but not the currencies are traded not in the spot market. Stock market, there are different kinds of transaction. One is a cash transaction or spot transaction. One is a derivative transaction. So in currency market, we have only derivative transaction. Stock exchange, for currency, we have only derivative transaction. There is no spot transaction in the currency market. Got it?
Yes, sir. Thank you.
But in the currency market, suppose State Bank of India buys dollar from Citibank, huge amount, or Tata Steel buys a huge amount of dollar from HDFC Bank. So here delivery will take place after 2 days. Got it?
Yes, sir.
So these are all OTC market. Spot transactions are OTC market. Okay? Two people, buyer and seller. Any question? Nikhil?
No, sir. Thank you.
What is a forward market? So spot transaction 25th of January, you buy something. So you will get the delivery on 27th of January. Similarly, 25th of January, you sell something. Sell something means foreign currency, of course. You will have to give the delivery by 27th and get the payment on 27th. Okay. What about forward market? Suppose you don't want to buy today. You want to buy after 1 month. So 25th of January, you enter into a transaction to buy $1,000 1 month from now. Okay. 1 month from now. So 25th of January, 1 month from now is 25th of February. Normally there are 2 days of grace days. So 27th of February. So you will get the delivery on 27th of February. Suppose you want to buy $1,000 1 month from now. So which is a forward contract. So delivery date will be 27th of February. Now the rate at which you will be buying, that will be determined today. Okay. Suppose when you enter into the contract, you and the seller, two of you agree at a rate of 75.2 rupees per dollar. So you will be buying $1,000 at the rate of 75.2 rupees per dollar 1 month from now. So after 1 month, that is on 27th of February, you will be delivering 75,200 rupees and he will give you $1,000. So that is what is a forward contract. Any question?
Yes, sir.
Yeah.
Sir, can you explain the application of forward market, like why they do, like for any profit or?
So there are many reasons for the forward market, but for the time being, suppose you will be needing $1,000 after 1 month. You don't need the dollar now. So why should you buy now? Now the question is, why not buy after 1 month? That is, if you have that question, I'll come to that later. You need $1,000 1 month from now. So you cannot buy now. Why should you buy one? So if you buy $1,000, 75,200 rupees will be blocked. Because once you buy the dollar, you cannot use the dollar. And in India, you cannot trade with dollar. Now, why you are not buying now is clear. That is, if you buy now, your money is blocked. Now, question is, why not buy after 1 month when you need it? After 1 month, price can be from 75.2, price can be 76 also. If that happens, you'll be losing a lot of money. So that is why you are buying now. This is the major reason you have a forward contract. So it is called hedging of risk. So in future, that is after 1 month, the price can change. And if the price change again, it's not in your favor, if against your favor. So naturally, you lose money. Of course, after 1 month, price can be 74. You can gain money, but your purpose is to first safeguard from yourself from loss. Then you think about profit. Make sense?
Yes, sir. Actually, sir, seller is also be aware na, about the loss he will make.
When you are buying at 75.2, you are estimating that the price can go beyond 75.2. That is why you are buying. Yes or no? Seller is thinking, seller is thinking the price will go below 75.2. That is why he is selling at 75.2. If seller also thinks that the price will go beyond 75.2, why should he sell at 75.2? So we talk about efficient market hypothesis. There must be some kind of inefficiency in the market. If everybody thinks the same price, naturally there will be no trade. Isn't it?
Yes, sir.
So forward market is clear?
Yes, sir. Good.
Let me give you some example. Suppose Reliance is importing a machine for $100 million. It goes to State Bank of India and says, I want to buy $100 million. State Bank of India says, okay, if you want to buy $100 million today, again, I'm telling you, after 2 days, the delivery will be after 2 days. So if you want to buy $100 million in the spot market, rate is 75. Okay. So what Reliance does, Reliance buys $100 million by paying 75 rupees per dollar. So how much money? 7,500 million. Yeah. Bolo?
$7.5 billion.
No, 7.5 na. 75 into 100, 7,500.
Yes, 7.5 million or 7.5 billion.
Oh, you said billion. I missed it. So this is a spot transaction. Is that clear?
Yes, sir.
Next is, suppose this same thing, Reliance doesn't have money now. Reliance takes a loan from Citibank New York. Whatever is the reason, why Citibank New York, why not from somebody else, let us not talk about that. Reliance takes a loan from Citibank New York, $100 million, and buys the machinery and imports the machinery. Now it has to repay it after 1 year. Suppose it borrows money for 1 year. It has to repay after 1 year. So it goes to State Bank of India. In this case, it is not buying in the spot market. It is borrowing in the overseas market. Suppose the rate of interest there is low, $100 million. With $100 million, it pays the importer and brings the machinery. Now for repayment of loan, it goes to State Bank of India and says, I want to buy $100 million 1 year from now. Forget about the interest for the time being. I want to buy $100 million 1 year from now. So State Bank of India says, okay, if you want to buy $100 million after 1 year, you have to pay 76 rupees per dollar. Okay, Reliance agrees. So they enter into a contract So after 1 year, what will happen? Reliance will deliver 7,600 million rupees and take delivery of $100 million. With that, it repays the loan. So the contract which it is entering into with State Bank of India is a forward contract. I repeat, what is the forward contract? Today it is entering into a contract with State Bank of India where it will be buying $100 million 1 year from now at a price of $1 is equal to 76 rupees. Any question?
No, sir.
So I have given you one example of spot transaction, one example of forward transaction. Okay. Now consider a case. Suppose Reliance borrows $100 million in the overseas market. Okay. Why it is borrowing? This time not for importing machinery. Suppose it is borrowing $100 million in the overseas market because it is cheaper to borrow in the overseas market. It is cheaper to borrow in the overseas market. Make sense? So it brings $100 million into India. Now in India, it cannot trade with dollar. It has to convert the dollar into rupee. Yes or no?
Yes, sir.
So once it wants to convert the dollar into rupee, it goes to State Bank of India, says, I want to sell $100 million. State Bank gives a rate, Reliance agrees, converts $100 million into rupee and start using that rupee in India. Again, it has to repay this $100 million, say 1 year from now. So it goes to HDFC, say it goes to HDFC. And it enters into a contract with HDFC and it buys $100 million in the forward market because it has to repay $100 million after 1 year at a price of say 76 or whatever it is. So HDFC says I am ready to sell $100 million after 1 year at a price of 76. Okay, so after 1 year, Reliance goes to HDFC, pays 7,600 million rupees and buys $100 million. Okay. So first one is a spot market contract, second one is a forward contract. Any question? Let me repeat the thing. Reliance borrows $100 million. So it brings $100 million into India, sells $100 million and converts that into Indian rupee. And it has to repay this loan after 1 year. So it again enters into another forward contract with says HDFC Bank where it will be buying $100 million after 1 year. So first one is a spot contract. Second one is a forward contract. Any question?
So there is one thing that in both the contracts, in both the transactions, spot transaction as well as the forward transaction, if I make both of them today, the rates will be same for both of them, right?
No.
No.
Spot market and forward market rates are different. Rishabh, do you remember we had done covered interest arbitrage during that period of time? I told you that is this what should be my forward rate. Like spot market, there is a forward market, their rates are available.
Yes, sir.
So forward market rates will be different.
Okay. Okay.
Okay. So two transactions is okay. One is a spot transaction, one is a forward transaction. Yes or no?
Yes, sir.
So suppose Reliance goes to State Bank of India and says that today I want to sell you $100 million, but I want to buy back this $100 million after 1 year. That is also possible. So instead of going to State Bank and HDFC, it can go to State Bank and say that today I'll sell you $100 million and I'll buy back this $100 million after 1 year. Possible?
So
Yes.
can you repeat what they will say? What they'll sell?
First of all, the example which just now we have discussed is Reliance sells to State Bank of India and buys from HDFC in the forward market. Now suppose Reliance goes to State Bank of India and sells it in the spot market and buys also in the forward market. Okay. So both the spot transaction and forward transaction, both it does with State Bank of India. Possible? Of course it is possible. Yes or no?
Possible.
Yes, sir.
So when Reliance does it, that is, it goes to State Bank of India, says that today I'll sell $100 million and I'll buy back $100 million after 1 year. When both these spot and forward transactions are done together, it is called a foreign exchange swap. Is that clear?
Sir, can you please repeat the last part? After selling $100 to SBI.
State Bank, it is at the same time it is entering into another forward contract with State Bank where it will be buying $100 million from State Bank after 1 year.
Yes, sir.
So it is called a foreign exchange swap. So what India was doing with Japan was foreign exchange swap.
Sir, is it kind of arbitrage like?
No, arbitrage you can do with foreign exchange swap, but this particular thing is clear. What is the condition of Reliance? Reliance borrowed $100 million and it has to repay $100 million. Today it has to convert $100 million. After 1 year, it has to buy $100 million. Today it has to sell $100 million. After 1 year, it has to buy $100 million. When a spot and forward transactions are together, it is called a foreign exchange swap. What is the advantage? Now, in the first example where you are selling to State Bank of India and buying a forward contract from HDFC, naturally, when you sell to State Bank of India, you will get a lesser price. When you buy from HDFC Bank, you will pay a higher price. But if you do both the transaction with the same bank, that is from State Bank of India, when you sell, you get a higher price. When you buy, you pay a lesser price than the earlier transaction. So that is why in a foreign exchange swap, that is why it is so popular. In a foreign exchange swap, you do both the transactions with the same bank and you get a better price. So that is why it is the traded mode. It's a combination of a spot contract and a forward contract, or it can be a combination of two forward contract. So for the time being, it is a combination of a spot contract and a forward contract. Is that clear to everybody? That is what is called foreign exchange swap. So 3.2 trillion in foreign exchange swap. Any question on foreign exchange swap?
Sir, I have a question. Like you have said, in case of swap, it is beneficial for the party to
remember the word swap is used in finance at different places to mean different things. So just immediately after foreign exchange swap, you see we have currency swap. Two are completely different. Okay, the English meaning of swap is exchange, but here in international finance today I have used two words of swaps. So next class when I will continue with this, you will see there are other swaps also. So this swap and this swap has different meaning. This probably I will not explain in detail because we have a separate chapter on currency swap. Got it? So now we are doing foreign exchange swap. So when you are mentioning, you mention in a foreign exchange swap. Yeah, carry on.
Yes, sir. So in case of foreign exchange swap, you told like it is beneficial for the party as in correlation with the spot transaction and forward transaction.
Let me clarify, Ankit. Suppose in the first example, what we are doing, you sell to State Bank of India and buy the forward contract from HDFC. Okay, $100 million. So suppose when you go to State Bank of India and want to sell $100 million, State Bank of India says, okay, I can pay you 75 rupees per dollar. Okay. When you go to HDFC and buy in the forward market, suppose HDFC says, okay, I will sell $100 million, but at a price of 76 rupees per dollar. So what is the margin? 1 rupee. Okay.
1 rupee.
You do both the transaction with State Bank of India. Suppose State Bank of India says, okay, fine. For spot, I will pay you 75.1 rupee. For forward, I will charge you 75.9 rupees. So what is the margin here? 80 paisa. Is this clear to you? So
yes,
when
yes.
you do both the transaction with the same person, your total cost is less.
Yes, sir. That was my question, sir. Thank you.
Yeah, got it?
Yes, sir.
Okay. Now I'll give you another example. Consider a case. HPCL. HPCL imports crude oil.
Yes, sir.
What does it do after importing crude oil? Refines.
It refines and sells in the market in terms of petrol.
Sells in the market. It also exports. Huh?
Yes, sir. It
exports. So consider a case. Suppose it is importing crude oil today. It is entering into a contract to import crude oil today, 25th of January. And it has to pay after 1 month. That is 25th of March. Forget about 2 days, 4 days and all. And it knows that it will be, it is not that when your crude oil will come, when you will start refining on, etc., everything, and when you are going to sell. Suppose on the basis of that, it can expect that it will be selling after it receives the crude oil, it will refine and it will sell it in the market. And the exporter and the party, that is the buyer, will pay after 2 months from now. So buyer will be paying on 25th of March. I repeat. So 25th of February, HPCL has to pay for its import. 25th of March, HPCL will receive for its export. Is that clear?
Yes, sir.
So 25th of March, it goes to State Bank of India and say that I want to buy a forward contract on 25th of March, for 25th of February, and I want to sell a forward contract for 25th of March. Both are done together. So always remember, whenever you buy or sell, whether it is spot market or forward market, there is a transaction cost. Is that clear?
Yes, sir.
So here also, when you do both the forward contract together, I repeat, when you do both the forward contract together, so your total cost will be less. This is also called a foreign exchange swap. Any question? So a foreign exchange swap can be a spot and a forward or 2 forwards. Yeah.
Can you please explain this again, sir? Just one.
2 forward contract.
Yes, sir.
So HPCL today it imports crude oil, for which it has to make the payment on 25th of February, 1 month from now. At the same time, it knows that it will be after refining, it will export the petroleum products, for which it will receive the payment on 25th of March. So its payment is due on 25th of February, which is 1 month from now. And it's if both are on the same day, like if its payment as well as its receipts both are on the same day, it will not enter into any contract, because on one side it will receive the foreign currency and another side it will pay the foreign currency. But its payable are after 1 month and receivables are after 2 months. So it has to buy one forward contract for 1 month and it has to sell another forward contract for 2 months. Again, when you do both the transactions together, your total cost will be less. Remember, whenever you buy or sell, there is a transaction cost. Okay. So here also you are making both the forward contracts you are making together. So your total cost will be less. This is also called foreign exchange swap. So a foreign exchange swap is a combination of either a one spot, one forward, or 2 forwards of different maturities, not of same maturity. Rishabh, is that clear?
Yes, sir. Got it, sir. Thank you, sir.
Any further question? So 6.6 trillion is 2 trillion in spot transaction, 1 trillion in outright forward, 3.2 trillion in foreign exchange swap, 108 billion in currency swap. Currency swap, again, we have a separate chapter. So this currency swap is totally different from foreign exchange swap. Currency swap is basically exchange of currencies. And 294 billion in options and other products. We have, again, for options, we have a separate chapter. We'll discuss that in detail. So these are more or less the breakup. Next question is, who all are and how you can participate. So among the participants, primary price makers or professional dealers who make a two-way market to each other. Like if you want to buy, you can buy from them. If you want to sell, you can sell to them. Okay, so they will give you two-way quote. When they are ready to buy, ready to sell. The difference is they will buy at a lower price, sell at a higher price. So the difference is their profit. Okay. Foreign currency brokers act as middlemen between two market players. Okay. Their main function is to provide information to market making banks. So banks, normally they are market makers. Corporations are usually price takers. What do you mean by price takers? They either buy or they sell. It's not that like banks, they do not buy and sell both. They either buy or sell. So however, some non-bank, non-financial companies do act as market makers. Large money center banks deal in a large number of currencies. Smaller banks have a restricted range. Which bank has what range? I'll come to that. Next question is, can you, let me show you the banks, this part, then I'll go to that. So you can read this geographically, the market span all over all the time zones. From New Zealand, I believe you know that we celebrate New Year first at Auckland. So New Zealand to the west coast of United States. So when it is 3 p.m. in Tokyo, it is 2 p.m. in Hong Kong. When it is 3 p.m. in Hong Kong, it is 1 p.m. in Singapore. At 3 p.m. in Singapore, it is 12 noon in Bahrain. So we here the main financial markets are mentioned. When it is 3 p.m. in Bahrain, it is noon and in Frankfurt and Zurich and 11 a.m. in London. So 3 p.m. in London is 10 a.m. in New York. So by the time New York is starting to wind down at 3 p.m., it is noon and Los Angeles. By the time it is 3 p.m. in Los Angeles, it is 9 a.m. of the next day in Sydney. So the gap between New York closing and Tokyo opening is about 2.5 hours. Okay. Till date, the number one market is London, but within a very short period, New York will become number one. Okay. So London, New York, London, Tokyo, these are the major centers which account for more than 50% of the total volume. The total volume is total $6.6 trillion. Is that fine? Okay.
Yes, sir.
Can you go and trade in the market? Achha, who all are the banks? Number one is JP Morgan. This is again date June 2019. So JP Morgan accounts for 9.81% of the total trade in the foreign exchange market. Followed by Deutsche Bank, 8.41%. Looks very, difference is not much, 1.40%. Remember, 1.40% of that $6.6 trillion of daily transaction. So you have daily transaction of $6.6 trillion. JP Morgan accounts for 9.81% of that daily, on an average. So number one is Deutsche Bank. Number three is Citi. XTX Market is not a bank. It is a dealer. They are foreign exchange dealer. It's a financial institution, foreign exchange dealer. It is not a bank like these three, whose duty is to accept deposits and give loan. No. So it is a foreign exchange dealer. UBS is a bank, Union Bank of Switzerland. State Street Corporation again is a dealer. HC Tech is a dealer. So these two, along with XTX Market, they are not bank, they are dealer. HSBC is of course a bank. Bank of America Merrill Lynch is a bank. Goldman Sachs was a merchant investment banker. Now it is a bank. So these are the top 10. Okay. Any question? If you want, can you go and trade in the foreign exchange market? Answer is no. If you want to buy foreign currency, first of all, your basic travel quota is $10,000. So as an individual, you can maximum buy $10,000 against your passport in a year. If you want to buy foreign currency, so normally you buy foreign currency for the purpose of tours and all. So you have to produce a passport, and but that is a travel document, and an air ticket. You may not need a visa for that, but you need an air ticket to buy the foreign currency, and that too you can buy foreign currency maximum 90 days before the date of travel. You cannot buy before that. So you can enter into a forward contract by 90 days. Forward contract, not forward contract, spot contract, but when? Maximum 90 days before that. Okay. Of course, informally you can buy from your what you call travel agent. So that's a different thing. So there is a spot market from banks or any foreign exchange dealer. You can buy maximum 90 days before that. Earlier, there were a lot of restrictions. Earlier, acquiring a foreign asset was absolutely impossible. That is, it was not possible for an Indian to buy any foreign asset. Now it is slowly it is possible. There is with a limit. See, 30% of Burj Khalifa is owned by Indians. Our former captain, President BCCI, President Sourav Ganguly has a flat in London. So now you can buy, but you need permission from Reserve Bank of India. India has more restriction than different countries have different restrictions. So this $10,000 which I'm talking about, it is your for travel. So for business tours, or if you want to study in a foreign country, for that the quota is more. That is, you can buy more foreign currencies. So now that has become slightly easier. Earlier it was very difficult. There are certain transactions, which may not be like, see, for example, earlier the credit card companies, they used to issue credit card for use in India and Nepal only, because Nepal also we trade with Nepal in Indian currency, not in dollar. Well, now it is international credit card. Sometimes, you will get notices from banks that is, this card is not for foreign currency transaction and all. But we do use, these credit cards for making foreign currency transactions. May not be, we do not buy foreign currency, but foreign currency transactions same. Just recently, on behalf of IFT, I just made a transaction and passport number was not required. Okay. So these are certain things probably, which are very small amounts. That is why probably it is not recorded. Otherwise, it would have been deducted from my basic travel quota of $10,000. You may not need $10,000, but that is the case. And when you leave India, you cannot carry more than $3,000 in currency. That's maybe increased now. Remaining part you have to carry in either in travel card or in traveler's check. So that's the rule. Similarly, you cannot leave India with more than 5,000 rupees in 5,000 INR in currency. So when you are leaving India, suppose you are making a trip, then also you are an Indian, suppose you are going out for 7 days, then also you cannot leave India with more than 5,000 rupees in cash. Similarly, a foreigner cannot leave India with more than 5,000 rupees in cash. So if you have more foreign currency, you have to convert that into Indian in a foreign currency at the airport at least. So different other countries have different kinds of restrictions. Say, for example, you cannot enter UK with foreign currency equivalent to more than 10,000 euro. I repeat, you cannot enter UK with foreign currency equivalent to more than 10,000 euro. So basic idea is different countries, they have put different restrictions in order to control the money supply. Okay. However, there are a lot of, though, see, for forward market, you cannot enter into. Forward market only the companies but to enter into a forward market, you need either an import order or an export order. Okay. So if you are an importer or an exporter, then you can enter into a forward market, but you need that import order and export order. However, there are again, you can avoid that. How you can avoid that? As an you can FEDI, Federation of Exporters Dealers Association of India, it has given permission to its members that they can enter into the foreign exchange market without an import order or export order. But if you have an import order, you can buy. If you have an export order, you can sell. Okay, in the forward market. So basically, you can enter into a forward market without an import order or export order on the basis of your average of last 25% of last 3 years turnover. This again we will discuss when we will do the risk management. At that time we will discuss this. But there are a lot of restrictions not only in India but many other countries for different reasons related to those countries. Any question, confusion? regarding foreign exchange market?
No, sir.
So what is the spot market? I have already told you that is, 2 days. 2 days means today if you make the transaction, the value date will be 2 days. Suppose 25th of January. So today if you make a transaction, the delivery will take place after 2 days, that is 27th of January. Okay. So if it is a holiday, 27th of January is a holiday, it will be pushed to the next date, that is 26th of January, 28th of January. If 28th of January is a holiday, 29th of January, and so on. Okay. So what is an outright forward contract? Outright one is only forward. Huh? What is an outright forward contract? That is, see, valued for a spot contract, your value days is 2 days. So outright forward is 2 or more, 3 or more. So if it is more than 2 days, it is an outright. 3 or more days, it is a forward contract. So normally nobody enters into a forward contract for 3 days, though theoretically it is possible. If you get a seller, you can buy, or if you get a buyer, you can sell for any number of days. But normally the popular forward contracts are 1 month, 2 months, 3 months, 6 months, 9 months, 12 months. So these are all popular forward contracts. Okay. So here also there are 2 grace days, I have told you. So spot value plus required calendar month. So today is 25th of January. If you enter into a 1 month forward contract, it will be 25th of February plus 2 days of grace days, 27th of February. If 27th of February is a holiday, then it will be 28th of February and so on. Okay. Here swap has a different meaning. Foreign exchange swap, a spot plus a forward or 2 forward contract. Just now we have discussed what is a foreign exchange swap. So buy US dollar spot versus euro, sell US dollar 3 months forward versus euro. So it's like that. So or 2 forward. So sell US dollar 1 month forward, buy US dollar 3 month forward versus GBP. So it's like that. Okay, so whatever currency you are buying, you are selling that in the forward market, or in 1 month forward, sell it in the 2 month forward, and so on. So it's a combination of 1 spot, 1 forward, or 2 forward. That is what is called foreign exchange swap. So a spot GBP US dollar deal on Friday, December 8, value date will be Tuesday, December 12. Why? Saturday, Sunday is a holiday. So Monday, Tuesday, 2 working days. If December 12 is holiday either in New York or in London, then it will be December 13. I repeat, if December 12 is a holiday either in New York or in London, value date will be December 13. Okay. A 2 month forward deal on US dollar Swiss franc on Monday, December 11. The value date is February 13, 2008. Okay. If holiday in either in New York or Zurich, February 14. But consider another case. A 2 month forward contract on US dollar Japanese yen on December 26. So value date should be February 28, 26 January, 2 months is 26 December, 2 months will be 26 January, 26 February plus 2 days, 28 February. But if 28 February is a holiday, it cannot go to 1st of March. Why? The holiday cannot push it to the next month. I repeat, holiday cannot push it to the next month. So a 2 month forward contract on US dollar Japanese yen on 26 December, value date will be 28 February. But if 28 February is a holiday, it cannot go to 1st of March. It will be 27th of February. However, if you enter into a transaction on December 27, automatically the value date will be 1st of March. Why? December 27 is the transaction date. 2 months, January 27, February 27. 2 days grace, February 28, 1st of March. So 1st of March will be the value date. What I'm trying to say here is, holiday cannot push it to the next month, but if it is automatically in the next month, then there is no problem. Any question?
Sir?
Of course, some transaction like between US dollar and Canadian dollar, it is settled in one business days, T+1. Yeah.
Sir, like what if 27 and 28 both are holidays? Will it be pushed to February 26th?
27th is also a holiday, February 26th?
Yes, sir. Because the forward contract ends on February 26th, right? On the same day will the amount be credited?
Doesn't matter. See, we are not counting that. The maturity we are counting as 28th of February. If that is a holiday, 27 normal course it goes to the next day, but since next day it falls on the next month, so that is why it will be preponed here 27. If that is also a holiday, 26. Now here we are not seeing whether after adding 1 month it is becoming 26 or it is becoming something else. Even if 26th is a holiday, it will be 25th, which may be less than 1 month. Doesn't matter.
Yes, sir. Thank you.
Question, confusion? So, certain things you need to know. One is a base currency, one is a quoted currency. One is a bid rate, one is an offer rate. Okay. Let me give you an example and then let me talk about this. So, this is US dollar, Swiss franc. 1 US dollar is equal to this amount of Swiss franc. Okay. So this is the bid rate. So US dollar is the base currency. Swiss franc is the quoted currency. I repeat, US dollar is the base currency. Swiss franc is the quoted currency. That is 1 US dollar is equal to how much Swiss franc? Is that clear? Bid rate, offer rate. Offer rate is also known as ask rate. So when you go to the bank will give you two rates. This is bid rate, this is offer rate. So if you want to buy, you have to pay more. So you have to pay 1.4580. This is your buying rate, bank's selling rate. So if you want to sell, you will be getting 1.4575. So when you buy, you pay more. When you sell, you get less. Similarly, when bank buys, bank pay less, and when bank sells, bank gets more. So the difference is bank's profit. So bank is making a two-way market for you. That is why bank is making this profit. So why it is called bid? When you want to sell, bank is bidding this rate. When you want to buy, bank is asking this rate. So offer or ask is another rate for offer rate is called ask. So what is base currency? What is quoted currency is clear. What is bid rate? What is ask rate is clear. So here the difference is bank's profit. So when a two-way quote is given, so there is no brokerage because the difference is your transaction cost. So sometimes instead of a two-way quote, there is a single quote plus brokerage. So first, another thing is popular apart from bid offer, we call it mid rate. What is the mid rate? This rate plus this rate divided by 2 is the mid rate. So 1.4575 plus 1.4580 divided by 2 is the mid rate. So it's coming to 1.4575. Suppose you go to the market and you are given a single rate 1.4577. Suppose it is given 1.74577 and a brokerage of 0.0003. So if you buy, how much you have to pay? 1.4577 plus 0.0003. So if you want to buy, you have to pay 1.4580. If you sell, how much you will get? 1.4577 minus 0.0003. So you will be getting 1.4574 in that case. So basically, when you are given a single rate, if you buy, brokerage will be added. If you sell, because total cost will be after both the cases you are paying the brokerage. So when you buy, whatever money you pay for the currency plus brokerage will be your cost. Similarly, when you sell, whatever money you receive minus the brokerage will give you the total receipt. Any question?
Sir, is the brokerage standard or it will be pegged to the rate? Like in if we trade in the stock market, it will be around 0.25% or something, 0.15% of the transaction cost.
So another difference between an OTC market and exchange traded market, in an OTC market, it is customized. Stock exchange, it is standardized. So stock exchange brokerages are standardized, though different brokers charge different amount. So if you trade through ICICIdirect.com, you have one brokerage. If you suppose trade through Kotak, another brokerage. If you trade through say another say Sharekhan, there will be another brokerage. India Bulls, another brokerage charges. So different brokers charge different amount. What SEBI says, maximum amount which a broker can charge, that is fixed. But in an OTC market, different, for that matter, like in stock exchange, two markets can give you two different rates. Like BSE and NSE, they can give you two different rates. Similarly, two different banks can give you two different rates. Not only that, two different banks can charge you two different amount of brokerage. Possible?
Yes, sir. Very much possible.
So that happens. So stock exchange, and what you are saying, suppose ICICI Bank says, whatever transaction you do, this is my brokerage. It can be as a percentage or part transaction, this is my brokerage. For here in foreign exchange market, the not only the your quotation, like this quotation, this bid and offer, they can vary on the basis of your what do you call quantity. They can vary on the basis of who you are, customer. Or my point, because it's a two-person. In an exchange, who is by, see, quantity wise it can vary, but the person wise, client wise, it may not, because the client is not known. Here, when Reliance goes to State Bank of India or Tata Steel goes to State Bank of India, depends upon who is more important to State Bank of India, who is a more important client to State Bank of India, Reliance or Tata Steel. So depending upon that rate can vary. And forget about the rate which is charged to you and me, which is the retail rate. So when retail rates are definitely, so if you go to, suppose this is the rate in the wholesale market. So if you go to the bank, you have to pay more. See, wholesale market, the rate, purchase rate, your purchase rate is 1.4580. If you go to a bank, you have to pay more than this, say suppose 1.4585. Similarly, when you want to sell, you will get less than this, 1.4570 maybe. Okay, so rates will, for retail rates are more costly. That is, if you want to buy, you have to pay more. If you sell, you will get less. So normally, what you rate, the rate which is available in the bank is the retail rate. They are normally fixed for the day. So at 10 o'clock when you enter the bank, whatever rate is published, 4 o'clock when you come out of the bank, the same rate is there normally. So you'll see we buy at this rate, we sell at this rate. But in the wholesale market, rates fluctuate like share prices fluctuate in every minute or every second. So it's like that. So every transaction, the exchange rate varies, changes. Question?
No, sir.
So this may not be represented in 1.4575, 1.4580. It can be only 75. It can be like this, 1.4575 stroke 80. So that means you have to understand that before this 80, it is 1.45. Okay. Or it may be 7580. Now, how do you know it is 7580? So probably at this moment, since we are doing international finance, we know that in Indian rupee is hovering around 74.75. Okay. Now, suppose somebody who does not keep any news of the exchange rate, so for him, it is possible that is today's rate is 75.45, 75.55. So Bank is ready to buy at 75.55. Bank is ready to buy at 75.45, and bank is ready to sell at 75.55. So you go to a bank, bank might quote you 45.55. Okay, so that means you have to assume that before that there is 75. But bank can quote you this rate only when bank knows that the other party knows that there is an 1.45 before this. So this last 2 digits are called points or pips. Okay, so when it is a trade between two parties, they will quote you these two rates. So and 1.45 is called the big figure. Any question? So these are all definitely, some of the notations. Deutsche Mark DM does not exist now. Dutch Guilder or Netherlands Guilder does not exist now because both of them have joined Euro. French franc does not exist. Spanish peso does not exist. They all join Euro. US dollar exists. Canadian dollar exists. British pound exists. Indian rupee exists. Euro is the new currency. Swiss franc exists. Belgian franc does not exist. Joined Euro. Danish kroner exists. Italian lira does not exist. Australian dollar exists. Japanese yen exists. Irish pound exists. Saudi riyal exists. So these are all different symbols of different currencies. So any question? Or next class, just remind me, we'll start from, this is 12. We'll start from, this is 12 means slide number 12, no? Slide number 12. Next class, we'll start from slide number 13. Okay?
Yes, sir.
Any question?
No, sir.
So, okay then, bye.
Thank you, sir.
Thank you, sir.
Let me also remind you at this stage, once we finish off foreign exchange market, will be our midterm. So hopefully our midterm syllabus will be up to foreign exchange market. Let's see how much we cover. 50% class, that is 7, class number 7 or maybe 8 maximum. Okay then, bye. This is already uploaded, huh?
Oh,
Yes, sir. Thank you.
thank you, sir.
Okay.
Thank you, sir.